Inflation has been on the rise recently and it's almost back to the levels it was seeing back in 2008 and 9 when the financial system collapsed and is worrying a lot of people due to increased cost of living and eroding the value of future dollars, which means that people will now have to work longer to maintain the same lifestyle they are living right now. In this video, we will be talking about why the United States is seeing increased inflation and what you, as a smart investor, can do to profit from what's coming in the next few months rather than letting your dollars slip in value even further. And we are starting right now. What's going on, guys? My name is Sharil, and you're watching Modest Millennial, where we talk about all things money that they don't teach you in school. So, if you are new here, please consider subscribing and gently hitting the like button to tell me that you like the idea of making money, saving money, and investing money. If you have been paying attention to prices of day-to-day goods in the market these days, everything seems relatively more expensive than what you're used to paying for it. Over the past year, even though food prices have stayed relatively same, gas prices have gone up more than 50% year over year, home prices have gone up 17%, and surprisingly, used car prices have shot up by almost 30% from 2020 to 2021. What is causing all this uptick in inflation, you ask? All the money printing that has been going on in the country over the past year has provided for a massive influx of new dollars into our economy. When the economy was shut down and people were forced to sit at home without having a job or a paycheck to rely on, the government had to step in and print all this new money to provide stimulus checks to people with low income and PPP loans to small businesses. These people then started spending that new money on everyday items such as buying groceries, getting their fuel tanks filled up. Some others that were still working started looking for new, more spacious homes owing to their new work from home jobs, and they started pushing the prices of everything higher and higher. But was the increase in the inflow of money the only factor responsible for causing this massive inflation we are seeing these days? Just normal people like you and I living our day-to-day life isn't the major factor causing this inflation rate. Do you think that just because I bought some bread or some yogurt last week, the inflation has gone up so high that I cannot afford to go out anymore? Probably not. A lot of the inflation we are seeing now is because of the significant supply chain constraints and major shortages of goods and services we have seen over the past year. It all started with the world shutting down in the middle of 2020 and bringing transfer of goods from one country to another to a grinding halt. That, combined with massive unemployment, meant that when all the industries started opening back up again, there was a shortage of people. Plus, all the unemployed people were getting massive support from the government in terms of stimulus checks and elevated unemployment payments from the state each week. So much so that for a lot of people, the weekly payments from unemployment were, and to some extent still are, much higher than what their jobs would pay them to work each week. Of course, for millennials like you and I that have more money coming in each week from just sitting on our couch and watching TV, why would we ever go back to work, right? So this was like a double-edged sword on the prices of goods because on one end, the supply got restricted due to border restrictions between different countries, causing plant shutdowns everywhere and shortage of labor due to elevated unemployment benefits from the government. While demand for certain products such as housing and cars went up, owing to more people that still had jobs now working permanently from home, or younger couples making their families bigger and needing more space or a larger vehicle and such. Fast forward to mid-2021, as the economy has been opening up since earlier this year, companies are still finding it difficult to bring labor back to work due to elevated unemployment benefits still being provided by the government. So, to counter that, companies have no choice but to offer a higher wage than before to incentivize people to come back to work. Now, these companies are not stupid. They won't just give their employees a higher wage to return to work and expect their profits to drop. They are in turn passing these added costs to us as consumers. Although on the surface it may not seem like you are paying more for everyday items, in reality you are. As even though the cost of certain items has stayed the same, the quantity you now get for the same cost has gone down. So companies are now giving you less product for the same amount of money as before. All of these things considered, the one goal that you and I have as a personal finance enthusiast is to understand what is going on in the market, which we just did, and then use this information to our advantage and profit from it, which we will talk about now. The first thing you can do to profit from inflation, kind of in a passive or an indirect way, is to lock in low interest rates. Of course, we have seen interest rates drop like a rock in the ocean over the past year, and debt getting cheaper and cheaper to carry. And when I say to lock in interest rates, I'm not talking about consumer debt. Consumer debt obviously has very high interest rates and should be paid off as soon as possible. But cheaper debt such as real estate and car loans can be relatively inexpensive to maintain, and with interest rates being dirt cheap, the best thing you can do to take advantage of this situation is to either refinance your mortgage to get a lower fixed 30-year mortgage if you already own a home, or if you are renting, maybe consider buying a relatively cheap property to take advantage of the rock bottom interest rates that exist at the moment. There is no doubt that interest rates will eventually start going up, but if you lock yourself up with a fixed rate on your mortgage for the next 30 years, no matter what the interest rates are 3 to 5 years from now, you will still pay the same fixed interest rate per month. To give you a better understanding of this, $1 in the year 1990 was equivalent to about $2 today, meaning that inflation grew by 100% between 1990 and 2021. If you were renting a place, an apartment that cost $1,000 in 1990 to rent would now cost $2,000 instead. Imagine that at the same rate. Not saying this will absolutely happen, but the $2,000 a month apartment in 2051 will cost $4,000 a month to rent, which is outrageously expensive. But instead, if you lock in a dirt cheap mortgage at the moment, by 2051, two things can happen. You will either be at the tail end of paying off your mortgage and completely owning the property you buy now, or between now and 2051, each month, that is, all the 360 months from now on until 2051, your mortgage will exactly be the same as long as you are living in the same house with the same mortgage, no matter how much inflation we see, or how much the interest rate goes up. The second thing you can do is to invest your money. And remember, the key here to invest it long term, not for the next few months or just a couple years. It has to be invested long term. Invest it in something like the S&P 500 index fund. Market data suggests that the S&P 500 has averaged an annual return over the past 100 years of roughly 10%. The average inflation in the United States since 1950 has been roughly around 3 to 3.5%. Accounting for inflation, the S&P has then still managed to provide a growth of roughly 7% each year that your money was invested in the index fund over the past several years. Of course, when I say an average return, it accounts for several years when the index saw a double-digit growth, as well as several years where it provided for a negative return instead. And that is why investing in the index long term is extremely important, as all these market fluctuations from recessionary periods, difficult times, slower economic growth, all of it needs to be averaged out in the return you will get for your money long term. Another major reason for investing in the index funds is that most of these companies that are producing goods that you are now buying at elevated prices due to inflation, meaning most of the high priced goods that are causing inflation, are actually a part of the index. So if you are buying toilet paper that is now roughly 15% more expensive than in 2020, provided you were able to buy any toilet paper in 2020 at all, that 15% increase in profit, if any, goes directly towards the cash flow for a company that is a part of the S&P 500 index, and in return, providing for a blowout quarterly earnings for the company and providing for a rise in the prices of the stock of the company and of course the S&P 500 index in return. You have no idea how many of the companies that you use the day-to-day products of directly and indirectly are part of the S&P 500 index. So definitely consider investing in the index and holding your investments for the long term. The third and the final thing to hedge against inflation and profit from it for today's video is to invest in cryptocurrencies, specifically Bitcoin. I am a firm believer in the potential for Bitcoin to be one day worth more than $100,000. Bitcoin is a digital asset that is perceived to have some sort of value to it based on how much work it takes to mine one coin. But there are only so many coins that can be mined, and really gives Bitcoin an increasing value potential as more and more adoption becomes a reality. There are already so many companies and institutions out there that have adopted Bitcoin and are planning to hold on to it long term to either use it as a store of value or to use it in the future to transact with. With growing distrust in fiat currencies like the US dollar and money being printed left and right to meet demands of people that are unemployed and companies that are going bankrupt, the government pretty much has the power to print any money they like and increase the supply of money in an already existing pool of money that you and I are a part of. When more money is printed by the government, suddenly everyone has a little bit more money to go out and spend, and as the demand goes up, the prices of everything go up as well. Bitcoin, on the other hand, is limited in supply, and thus as demand for Bitcoin increases to mass adoption, Bitcoin's price is expected to go up. How this ties into inflation is as inflation with fiat currencies goes up, people start to lose trust more and more in the fiat currency controlling power, and that is when alternative currencies go up in value to hedge against any inflation in regular currency. That is why we have seen gold prices shoot up during periods of widespread inflation in the past, as gold has always been considered as a hedge against inflation. The only difference between owning gold versus Bitcoin is that Bitcoin is more digital than a physical asset, and you can transact with fractional Bitcoins if you wanted to. But cutting down a bar of gold into 1/10 of its size is practically not possible to transact with. Also, over the past 10 years, Bitcoin has consistently earned higher returns compared to the stocks, except for the year 2018 when Bitcoin was down by 72%. Also, during the same 10-year period, Bitcoin averaged an annualized return of 230%, which accounts for about 10 times the return gained by the Nasdaq index. So, to say the least, Bitcoin shows potential for massive gains over the long term. Once again, guys, do your own research and talk to your financial advisor before making any decisions. This video is not meant to be financial advice, but rather a reality check to give you something to think about. That being said, go check out my BlockFi link below to get $10 worth of free Bitcoin. And while you are at it, also don't forget to check out my VBull link in the description to get 2 free stocks all the way up to $250 in value. Thank you so much for watching, guys. I really appreciate it. And as always, please don't forget to like this video below and subscribe to my channel for more personal finance videos. Also, if you are tired of just watching me in this small frame, please follow me on Instagram, where I share spicy insights of my personal life and how I save money pretty much on a daily basis. Alright everyone, see you again soon. Thanks so much for tuning into my channel this week.